Hi, I'm Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Nathaniel Ekman and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer your questions. Please note that this presentation will be available on our website. That's www.valueline.com and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is provided weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by the Value Line economics staff. Inflation has been running above the Federal Reserve's target rate of 2%. However, the consumer price index did moderate notably in June from a very high May figure. Specifically, the CPI fell 0.4% on a month-to-month basis, the biggest drop in 6 years. The core CPI, which excludes the food and energy components, was unchanged. On a 12-month basis, the CPI and core CPI rose 3.5% and 2.6% respectively, with both readings coming in below forecasts. Likewise, the producer price index, PPI, fell 0.3% last month, with lower oil prices playing a big role. That said, the geopolitical landscape remains unsettled. Talks between the United States and Iran to end the war recently broke down after Iran violated a ceasefire agreement, firing at ships passing through the Strait of Hormuz. That act brought retaliatory military action from the U.S. and an announcement that the blockade preventing ships from freely entering the key waterway was again in place. This put upward pressure on oil prices, which had fallen in June on hopes that a peace deal would soon be reached. An extended period of higher crude prices would make the Fed's task of reining in inflation more difficult and might push the central bank to raise the benchmark short-term interest rate later this year, despite the easing of price growth in June. In the meantime, the Treasury market seems to be doing the work for the Fed, with yields rising this month. Second quarter earnings season is underway. The major banks got off the reporting season, the major banks got the reporting season off to a rousing start, easily surpassing revenue and profit expectations. In general, Wall Street is forecasting that profit growth for the S&P 500 companies exceeded 20% in the three-month period, powered by spending on artificial intelligence infrastructure, i.e. memory and processing chips and data center construction. This technology growth continues to provide support for stocks, along with some volatility, even as concerns about excessive AI capital spending build. In conclusion, stocks should remain the primary investment in one's portfolio, especially with earnings growth for the S&P 500 companies forecast to exceed 20% this year. At the current market multiple, this profit growth would suggest more upside for the index to year's end. On that note, Value provides a great deal of information and analysis to help our subscribers. We know that most of our print and digital subscribers depend on our weekly stock reports, time-tested ranking systems, and other valuable resources. To that end, we're constantly working to improve our offerings in order to ensure the best possible experience for our subscribers. Our latest innovation is that, in that regard, is the Value Line digital booklet, which offers subscribers a powerful new tool to see the information we provide digitally and a faithful reproduction of its original printed context. To access the digital booklet, first head to the dashboard where I'm currently located, then click on the investment survey under traditional online access. From there, the digital booklet for both the current and back issues can be assessed. Once the digital booklet is open, navigation is as easy as flipping the page or alternately jumping to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Byline provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access these reports. First, head to the dashboard. Under the quick links, click on supplementary reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to build their cash reserves over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of the company balance sheets, Value Line has been reviewing and updating our proprietary financial strength grades for stocks in our coverage universe. These changes are posted each week in the Selection and Opinion newsletter. For those of you that don't know, financial strength along with price stability, another proprietary Value Line measure, are the two key metrics that are used to calculate a stock's safety rank, which is an important tool to measure risk. When considering a new stock to invest in, we strongly suggest utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and rankings, Value Line provides a user guide that can be accessed via the investment education section of our website. Now let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Today, we're going to be looking for reliable companies that balance strong year-ahead prospects with good return potential over the long term. First, we're going to look at safety rank of 2 or better. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale, 1 highest to 5 lowest, with 1 including the most conservative issues. I want to highlight that the fact that while stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. By applying the first criteria, we trend our potential candidates from 5,700 to 430. Now we're going to look at timeless rank. The timeless rank is used to predict the relative 6 to 12-month performance of stocks in the Value Line universe. The format is an easy to understand scale from 1 to 5, with those ranked 1 likely to be the best performing issues on a relative basis. Most often, buyers will want to avoid stocks ranked 4 or 5, while those ranked 1 or 2 are considered above average. Today, we're going to look at stocks ranked 2 or better. After applying that filter, we should be down to 72 candidates. The next filter we want to use is financial strength rating of at least A+. We want to focus on companies with solid balance sheets and overall finances. By applying that filter, we are down to 19 candidates. We also want to look at total return. We're going to look for companies that generate a respectable total return of late. In particular, we're looking for a return of at least 10% over the last fiscal year. After applying this filter, we are should be down to 11 candidates. Our final filter is projected 3 to 5 year annual percentage high total return of at least 10%. We will also want to emphasize companies that are likely to continue to generate solid total returns moving forward. By applying this screen, we chip the list of prospects down to our final 6 candidates. They are Bank of America, ticker symbol BAC, Fastenal Company, ticker symbol FAST, Alphabet, ticker symbol GOOG, Linda PLC, ticker symbol LIN, Shell PLC, ticker symbol SHEL, and the Travelers Company, ticker symbol TRV. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one stock can be today's one stock to buy right now. And after consulting with a number of our senior analysts, we prefer and recommend Bank of America. Before I click on Bank of America, please note that our screens can be saved and revisited by utilizing the Create Save screen at the top right, excuse me. Now let's click on the last full-page report on Bank of America. Bank of America provides a wide range of financial services, including personal and business banking, investment management, lending, and digital financial solutions. As can be seen in the financial rate in the middle of the page, the company has performed well over the past few years, and we look for that trend to continue moving forward. Bank of America's second quarter 2026 profits were driven by broad-based growth across its businesses. Higher net interest income from loan and deposit growth, record equities trading revenue, fueled by volatile markets, strong investment banking fees, and increased wealth management fees all contributed to higher earnings. Lower provision for credit losses and continued expense discipline also supported profitability, resulting in net income of $9.1 billion on revenue of $31.6 billion. Bank of America's immense size and financial position place it in a strong competitive position. It is today's one stock to buy right now. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few questions were submitted prior to the presentation. Now I'll hand it off to Nathaniel and Charles.
Thank you, Alan. It's Charlie Moran, I'm sorry. Go ahead, moderator.
As we go into the Q&A, I just want to remind everyone to use the Slido panel on the right-hand side of their screen to ask questions at this time. You can do this by clicking on the green S Slido symbol in the bottom right-hand corner of your screen, or select Apps or Slido. It will take you to the same area. Once you're there, you can type in your question and hit Submit. If you're on a mobile device, you may have to select the 3 dots, go to Advanced, and then you can select Slido, and it'll take you into the same Q&A area. I'll go ahead and hand it back over to you to answer questions.
Thank you again. It's Charlie Moran. I'm a senior analyst here at Value Line, and we received a question during the presentation. Please discuss the PE ratio in more detail and how it can be useful for investing. The price earnings ratio, or the PE ratio, or PE, is the most widely used statistic in investing. If you are like most accomplished investors, you will not make a move without knowing the PE ratios of the companies whose stocks are on your short list. In addition, you will regularly check the PE ratios of the companies whose shares that you own. The PE ratio is a measure of a company's market value relative to its earnings. In the most basic terms, a PE ratio is the price of a company's stock at the close of the previous trading day divided by its share earnings. Value Line calculates the PE ratio by dividing a stock's current price by an earnings figure that includes 6 months of past earnings and 6 months of projected future earnings. Let us say a company's share price is $40 and its earnings per share is $2. Its PE ratio would be 20, $40 divided by $2. If the company's earnings jump to $2.50 and its price remains at $40, then its PE would be lower to 16, a more attractive scenario in this case. There's no right or wrong PE. Expect to pay a higher price and accept a higher PE for companies whose earnings are accelerating. The opposite is true for companies whose earnings are flat or growing slowly. If you believe that earnings are poised to take off before the market recognizes it and the company is maintaining its current PE ratio, you might want to buy now in anticipation of a future earnings jump. In fact, depending on your tolerance for risk, you might be willing to pay a relatively high price for a stock with low or even no earnings in anticipation that it will be a standout moneymaker in the future. On the other hand, if our analyst projects continuing growth for a company but its PE is already high, you may want to wait for a pullback in price before committing funds so you do not pay more than you want based on the total return you anticipate. You will also find a trailing PE ratio and a 10-year median PE in our data. The trailing PE does not consider future earnings. It divides the stock's previous trading day's closing price by the most recent 12 months of actual earnings. The second question that we received is, what is Value Line's target price range? When your strategy is long-term growth, your goal is to buy stocks with potentially above average price appreciation. Our analyst-derived 3 to 5 year target price range is one of your most important tools for identifying these stocks. Target price range is a forecast of where Value Line expects the average price of a stock to be in the next 3 to 5 years. This range is based on our analyst's informed estimate of company earnings during this period multiplied by the analyst's estimated price earnings ratio for the same period. The difference between a stock's potential high and low prices depends on the stock's safety rank. Expect a stock with a high safety rank to be more stable and therefore to have a narrower band. A stock with a low safety rank is likely to be more erratic and therefore have a wider range. Because the analyst calculates the target price range using an estimate of future earnings based on information available at the time it is calculated, this measure is subjective. As company performance changes in the future, the target price range will also be altered. Okay, I'm looking more for other questions. Nate, do you see any?
Yeah. I've got a question here from Zach. What is the cost of Value Line for individuals? And the answer is, it varies. We have a variety of different products and services at different price points. Some are purely digital. Some offer print and digital. So we have a full investment survey, which is more expensive, but you can get a more tailored service with a more limited collection of stocks cheaper. In addition to the survey service where you would receive pages like this, we have specific selection services where you can get a specific stock recommended to you each month. For example, if you like this format where we present you with one stock that we think is the absolute best of the overall universe, you might want to check out our Value Line Select product, which is very similar. But we also have monthly selection services that are focused on specific areas. For example, our climate service, where we recommend a stock that is likely to do well based on sort of changing climate and responses to that. So we have a whole bunch of stuff at, like I said, a variety of different price points, ranging from, I believe that our cheapest is something like a $50 a year subscription, up to products that cost closer to $1,000 a year range. So it is a very wide variety, just depending on what your budget is and what you want. So if you want to see a complete catalog of our products, you can find that at investors.valueline.com. I definitely encourage you to look, and I'm sure you'll find something that works for you. Another question I'm seeing is, how much do we consider the history of stock buybacks when selecting a company? And the answer is, it depends, right? You know, buybacks are one way, obviously, of returning capital to investors. They're not the only way. And it depends a bit on industry. You know, certain things are more standard in some industries than others. For example, you're generally not going to see a high dividend, right, in like, you know, sort of a bleeding edge tech company. They don't really do that. And the fact that they're not doing that when it's not really something you would expect to see is not necessarily going to be a huge ding on our assessment of the company. And so it depends on what the company is. It depends on the fundamentals of the company, right? Like if a company has a history of stock buybacks, but it's not looking so healthy right now, and it seems like they maybe can't do that anymore, of course, we're not going to, you know, weigh that history necessarily as highly as we would with a, you know, super stable company. So like everything, you know, it's contextual, and we tend to take sort of a holistic approach to analyzing companies here. I think that's all the questions that we have
Yeah, I don't
right
see anything.
now.
Thank you, Wilson.